Good evening, sir.
Good evening, sir.
Yes, sir. Good evening, sir. How is everything? How today's work, sir?
We thank God, sir. Today was fine, sir.
Okay. Thank you so much. Good evening, Mr. Kehinde, and welcome to the class. Welcome to today's class. Good evening. So kindly let us wait a bit, maybe 1-2 minutes for let us wait for some minutes, maybe 1-2 minutes, to see if we can have 1 or 2 people joining again. So we'll start immediately after 1 minute, please. Well, let us hope that they will join us anyway, so that we can save the time. So let's Let's commence class. This is 5 minutes after. Now, the topic today is variance analysis. I hope you understand when they say variance analysis. I hope you understand the meaning. Now, when we say variance analysis or they call it standard costing, they just added it to the syllabus. It was not there before, but newly they added the variance analysis. I think it will be because of the fact that most of the students are coming from the foundations are having problem in solving issues, in dealing with issue on variance analysis in skill level. That's why they actually put this variance analysis in the foundation level. Now, so that you must have seen it in foundation before you want to get to what to skill. So it won't be so strange when they get to the skill level. So I think that's more of the reason why they included it in was in the syllabus. So in this going by this background, I mean we need to now look at what exactly are we doing when we say variance analysis. Now, what do we use it for, and what are ways or what of resolving it in the exam? Now, I want you to understand that when we say variance analysis, there are two basic. Listen, there are two basic words there. That's variance and analysis. Variance and analysis. Now, when we say variance, we are actually looking at the difference between two set of results. That is a difference between actual results and expected what? Expected results. It simply means that a manager of a manufacturing entity will have at the back of his mind what his expected result to be. I get what exactly he is expecting to happen. But eventually, what happened after the production process is what is obviously different from what they envisaged or expected. Take for instance, a manager that is producing bread. It's possible that he must have had at the back of his mind what will be the cost implication of bread productions. How much will be the cost of the material, the cost of the labor, the cost of the labor overhead that he will likely incur when he's producing the bread. Now, that is the expected result. But what now actually happened after the production process and after the sales will now be obviously different from what he envisaged or what he expected. Now, the difference between what he expected and what the actual results are, that difference is what we call variance. Like the analysis I gave you in a nutshell. Now, when we're looking at variance, we're looking at that cost of material, that cost of flour that they envisage to what to incur, and the flour cost they now eventually incur after they have finished productions. That difference is what we call a variance. If they had in mind that they are going to incur 10 naira on material, on flour to produce one bread, and eventually they now incur what? They now incur 12 naira on material, on flour to produce what? To produce one bread. What's the difference between 10 naira they went to incur and the 12 naira they actually incurred? That difference is actually the variance, which is the 2 naira. That means that the difference between the expected cost and the actual cost, which is 2 naira, is what? Is the variance. I hope I get it. Now, our concern is that how do we analyze this variance? How do we know what comes about? Why do we have these variances? So that in the future, this difference will not be what? Will not come up again. Again, that's when you say you are analyzing the variance. You are analyzing the variance just because you want to ensure that in the future, that cost implications will not go beyond what you planned. And at the end of the day, you will put your costs under control so that your profits of organizations can be maximized. That is the focus of variance analysis. So, and it's always done by what? By a manufacturing manager. I hope I get what I'm saying. A manufacturing manager is the one involved in looking at what's different between the budgeted cost, what costs are we envisaging to incur, and our cost difference. It can be looking at the difference between sales. That's why we said variance is more of the difference between actual results and budgeted results. How much do we incur? How much do we actually sold? That's actually the difference that we call the variance. And you looking at the reasons for that variance, looking at the reasons for that differences is what we're actually dealing with when we are talking about variance analysis. I hope I get what I'm saying. Okay. If you are, how do we determine this variance? Variance kind of a table that will help us to know those variances. before you can start, what are the variances that you'll be contending with in the exam? And let's look at those variances that we are going to be contending with in the exam. Oh, Miss Obiseson, so sorry, I was mistaken for, okay, I'm sorry. Okay, Miss Obiseson, thank you. Welcome, please. Welcome, I'm so sorry. I thought talking to a man, Miss Obiseson. Okay, thank you. Okay, now look at it. Now we are actually looking at the difference between the words before they start the production at all. They must actually have the mind of what profit are they looking at making. That's the projected profit, and what is the actual profit. Now we want to see what are the different, what must have had at the back of our mind, that this is the profit we are actually looking at making, and eventually, before we start production, we have a mindset of what profits we are looking at making. Maybe 10,000 naira profit. Now, eventually, at the end of the day, we now make a profit which is different from that budgeted profit. Now, this is now the actual profit. Now, can you now see that the actual profit now it can be 12,000, while the budgeted profit was actually 10,000? We now want to see why is it that we're having difference between what the profits we were envisaged to make and the profits you now actually made. Now, the difference is now what we call a profit variance. I hope you're getting me now. Now, in the exam, we now want to see what's the reason for this profit variance between the profits we want to make at the beginning and the profits we actually make after the production and sales. So that difference is what we call the profit variance. And that variance can be due to two different things. The basic reason why we can have the differences or variance in the profit is due to two things. The two things are what? The cost or the sales. It means that if the cost we incur is actually more or less than the cost we envisage to incur, it will affect this profit. It will make the profit we want to make different from the profit we actually make. The second reason for this variance in profit can be due to the what? Difference in what in sales. If the sales we envisage to make is now different from the sales we now actually make, that's just one another reason. I guess what I'm saying. Can you now see that the two reasons why we can have disparity in our profit can be due to the cost and what? And sales. If the cost is more or less than the cost we envisaged, I guess it, then it can affect the profit variance. Why if the sales we are making is actually less or more than the sales we now envisage to make, it can also affect the profit variance. Now, the concern now in the exam is that what is it about the cost that can bring about the variance in what? In profit? What is it about the cost that can bring about variance in profit? And what is it about the what? About the cost that can bring about variance in profit? That's one. And what is it about the cost, about the sales that can bring about variance in profit? That's two. So these are the two things we need to highlight, and we need to ensure that we resolve. I hope you get what I'm saying now. So let us look at it together. Now, one minute, okay. Let's look at it together and see how that can work and play out. Now, look at it. We have a budgeted profit and actual profit. I would say the difference can be due to what? Cost and what? And sales. Let's look at the cost variance. What is it about the cost that can bring about profit variance? Now, there are two things about the cost that can bring about the profit variance. The two things are what? The two things are one, about four things about the cost that can bring about profit variance. I'm sorry, four. It can be the cost of materials. It's possible it's cost of labor, the cost of variable overhead, and the cost of what? Of fixed overhead. Let me explain again. We are looking at what are those things about the cost that can bring about the profit variance. I guess there are four things about the cost that can bring about the profit variance. Those four things are one, it can be material cost, it can be labor cost, it can be variable overhead cost, and it can be fixed overhead cost. Now, when we say material cost is talking about if the cost we want to make or incur is now more than the cost we now actually incurred. I get it now. Then that means that it will affect the total cost of the organizations and to affect this profit profit. That variance is what we call the material cost variance. Now, it can also be labor cost we envisage to incur. That means that that's a labor variance, and that can also affect the cost, total cost, and affect the profit. The next cost element is what is variable overhead cost. That's if the variable overhead cost we envisage to incur is now more than or less than the one we actually incurred, then that will affect the total cost variance and head cost variance. Now, what is it about the fixed overhead cost variance? If the one we envisage to absorb into the cost of product is more or less than the one we actually absorbed, it will affect the cost variance, affect the profit. So you can now see in the exam, examiner can now ask you to compute all these variances. I guess you should just first know that the variances under cost are either material cost, labor cost, variable overhead cost, and fixed overhead cost variance. That's the under cost variance. Why under sales variance? Either the sales price variance or sales volume variance. I hope you get what I'm saying now. So let's look at the sales now. The variances under sales can either be two. The first one is what? The sales price variance, while the second one is what? Is the sales volume variance. Now, it means that the two things under the sales can either be maybe because the price you are selling is different from the price you actually sold. Why for this is what the volume you want to sell is different from the volume you actually sold. I guess what I'm saying now. So it means that the price difference, the sales price difference can affect the what? The sales variance can affect the issue, affect the profit. And if the quantity we want to sell is actually different from the quantity we actually sold, that's the sales volume variance, it will affect the profit. So in a nutshell, what we are talking about here is that what? We are looking at the sales price. This is SPV. We call it sales price variance, and we call it what? SVV is what? Sales volume variance. We can find a way of writing it down. Sales price variance is SPV, while the sales volume variance is what? Is SVV. So those are the two things that can affect the what? The sales, and can affect the profit of the organization. Now, you now need to cascade this down to what? To the components of the material. What is it about the material cost that can affect the total cost of material and affect the total cost of the organization and affect the profit of the organizations? I get it. There are two things about the materials. The two things are either the price you are buying the material or the quantity of the material you are using. Now, it means that price you are buying, the variance in the price is material price variance, while in the usage is material usage variance. Now, in a nutshell, what I'm saying in essence is that if you are finding a variance in in material, it means that it can either be either the price you are buying the material is actually more or less than the price you actually bought. The price you want to buy it, maybe you want to buy a material for 10 naira per kg, you now bought it at 2 naira per kg. That means that there is a variance in the price of the material. That variance is what we call material price variance. Now, it can either be material usage variance. Maybe you envisaged or you projected that they must not use less than or more than 2 kg to produce one bread, 2 kg of flour to produce one bread. And at the end of the day, the number of kg they now use is now 3 kg. Can you now see that the quantity that they are using now is now more than the quantity we envisaged? Now, that quantity difference is what we call material usage variance. Now, you can now understand that when we say material cost variance, it's actually subdivided into two parts. It's either is material price variance or material usage variance. Now, let us now look at the labor. What is it about the labor cost that can affect the total cost of the organization and affect the profit of the organizations? Now, there are three things about the labor which can lead to what? Labor cost variance. You can write it down. I just have to I will rate it here. Now, the first one is the rate of payment. Then how much are we paying and how much do we want to pay for labor? It's possible that we want to pay 2 naira per hour. That's what we say to pay. But at the end of the day, what we are now paying is now what? Is now more or less than what we say to pay. I hope you get what I'm saying now. That is what is a labor rate variance. That's the disparity in the rate of payment. If the rate of payment is different from the rate we envisaged, then we say we have a labor rate variance. But we also have labor efficiency variance. Labor efficiency variance is talking about, that's LEV. It's talking about how efficient are the workers, in the sense that if we want the workers to use 2 hours to produce one bread, and we now realize that the workers are now using 3.5 hours or 3.5 hours to produce the bread, that means that the workers are not efficient. It means that they are using an hour that is more than the hour they were envisaged for them to use. They're going to incur more cost in that process. That variance in labor due to the efficiency or inefficiency of the worker in respect of the hours they are using is what they mean by what? Labor efficiency variance. Now, the last one there is what? Idle variance. That's what I put as IV. Idle variance. Idle variance is the variance that is caused as a result of what? Of the organizations paying for hours not worked. It means that if the organization is paying for the hours not worked, then there's a variance they're called idle variance. Now, in the sense that if the organizations envisage that the hours hours they paid for, maybe the hours they pay for is 100 hours, but they realize that the hours, can you not see? They work 90 or they work to the tune of 100 hours, 10 hours. That means that 100 minus 90, which is 10 hours. That 10 hours is an adverse variance called idle variance. It means that it's a variance that is caused as a result of what? Of the hours we are paying for more than the hours they worked in the organizations. And please don't forget, so idle variance is always a negative what? A negative variance. It's always an adverse variance. I get it now. Before I continue, in the exam, when you compute all these variances, you must be able to indicate to the examiner whether the variances that you are computing is either favorable or what? Or idle. I hope I get what I'm saying now. When we say something is favorable, that means that what I eventually incurred in cost is lower than what I wanted to incur. I get me now. That means that it's favorable. Otherwise, it's adverse. That what I incur, if it is more than what I envisage to incur, that means that it should be what? An adverse variance. I want you to know that you must be able to interpret this correctly in the exam. Now, apart from that, if it is sales that you are interpreting, if what you sold is actually more than what we wanted to sell, that means that that's variance. That's favorable variance because you are selling more than what you envisage to sell. But if what you envisage to sell, if what you actually sold is what is less than what you wanted to sell, I guess you say that's adverse because that will impact negatively on the profit of the organizations. I hope you're getting it. So at the end of the day, you must know that for all these variances that we're talking about, is either they are favorable or adverse. The one that pays the organizations is a favorable one. The one that affects the profit of the organization negatively is what is the adverse one. So you should be able to interpret it correctly. Because the examiner will not pardon any student that compute the solution rightly but refuse to put the appropriate sign, whether adverse or favorable. It's very important. Now, I've explained the labor variance, then I'm now going into what? Into variable overhead cost variance. Now, we're looking at the variable overhead that they are absorbed into the cost of product. Now, that variance can either be due to what? The variance can either be due to what? Variable overhead expenditure variance and variable overhead efficiency variance. It simply means that let's start with this efficiency variance, VEFFV. That's variable overhead efficiency variance. You can put it down. Now, when we say variable overhead efficiency variance, what do we mean by this variable overhead efficiency variance? We mean what are the variable overhead that is caused by what? That is caused by efficiency or inefficiency of the worker. I get what I'm saying now. It means that variable overhead that is caused by what? Efficiency or inefficiency of the worker. That simply means that that's a variable overhead efficiency variance. That simply means that if the worker is efficient or not efficient, it will impact on the variable overhead absorbed into the cost of product. That absorption, that variance that is called in variable overhead that is caused due to that efficiency or inefficiency of worker is variable overhead efficiency variance. Now, the next one is variable overhead expenditure variance. In this instance, we are looking at what are we expecting to incur in total as variable overhead and what do we actually incur. I get what I'm saying. That's variable overhead expenditure variance. So please note them. I get it. Now, the fourth one under cost that can bring about disparity between budgeted profit and actual profit. Now, is the fixed overhead cost variance. Now, under the fixed overhead cost variance, that's where I want you to be a bit patient when you are interpreting the fixed overhead variance. Now, what is the meaning of this fixed overhead cost variance? This fixed overhead cost variance is the variance, listen, that is due to the what? Over absorption or under absorption of fixed overhead into the cost of product. Let me explain again. When we say fixed overhead cost variance, sorry, please. When we say the fixed overhead cost variance, fixed overhead cost variance is the variance that is due to the what? Over or under absorption of the fixed overhead cost into the cost of product. The meaning being that, you see, the fixed overhead in the organizations, there's a way they absorb this cost into the cost of product, like the cost of the what? Of the factory rent. I guess now, how do we find a way of including this cost into the cost of the what? Of the bread? I guess the way they include it is through what they call overhead absorption rate. I guess overhead absorption rate. Please don't forget, there is a way they do this rate in such a way that activity level, in the sense that we'll find a way to first estimate or project our output. That okay, in a year or in this year we are looking at what are producing 1,000 units in this year. That's your projected output. Now, on the basis of that projected output, we will determine what is the rate of absorption. We just divide what is amount we are projecting for the overhead, which is maybe 1 million naira. We now place it on that budgeted output of 1,000. That means that 1 million naira budgeted cost, budgeted fixed overhead cost over 1,000 naira budgeted what? Budgeted output. We now find the rate. The division of these two will give us a rate of absorption. That will give us a fixed overhead rate of absorption. Now, the fixed overhead rate of absorption you get now, if it is, let's say for instance, it's 10 naira. Now, it is that 10 naira now that you now use to multiply how much do we actually produce. You know, we used 1,000 units as a budget the other time. Assuming what they now actually produce is now 1,200 units. You know what I'm saying? Now? It simply means that the 10 naira you arrive at under the fixed overhead absorption rate will now be multiplied by the 1,200, which is the actual activity or actual productions. I get it. If you now multiply it, whatever you get is how much will go into the cost of the bread. You now understand now that we budgeted to produce 1,000 units, but at the end of the day, what we now actually produce is now more than the 1,000 units, which is now 1,200. That means that if you want to include the cost of the fixed overhead into the cost of the product, we now include it using the 1,2, which is the actual productions. And the actual production is different from that budgeted production of 1,000. But we use the 1,000 to get the rate. Meanwhile, there is an over absorption of how much? You know, it was 1,000 with what we envisaged to produce, but we produce 1,2. That means that the difference in that output production, which is 200, times that rate of absorption, which is 10 naira, I'll give it 2,000 naira. Which is 2,000 naira. That means that I have over absorbed 2,000 naira into the cost of product. What is the reason why I'm over absorbing it? Because what I projected, which is 1,000, is different from what I actually produced of 1,200. So that difference is the volume difference. That's 200 volume difference. That is what they mean by one fixed overhead volume variance. You can understand with me now that fixed overhead volume variance is not just a variance that is just due to what you want to expend and what you actually expended. No, its difference is what is caused by the what? By the over or under absorption of fixed overhead. If fixed overhead is over absorbed, the profit will drop. I get me. If the fixed overhead is over absorbed, that means that what? The cost will be what? Will be increased, and the profit will be what? But if the fixed overhead is under absorbed, what happens? It means that the profit will what? We go up. And the profit go up, that means that that affects the profit of the organization. You see, this over or under absorption of fixed overhead that is due to the volume difference or volume of production difference is what they mean by what? fixed overhead volume variance. And this volume difference can either be due to the what capacity or efficiency. Capacity is now talking about what are we having the capacity to produce and what do we actually produce. I get what I'm saying now. In the sense that we're estimating it in terms of hours of productions anyway. And the efficiency is talking about are we efficient in that how many is the hour we envisage to produce what we actually produce and how many is the actual hours. That's efficiency. I get me. So this capacity variance and efficiency variance are variances that you express in hours of productions, and they are the subdivisions of what? Of the fixed overhead volume variance. Now, the fixed overhead, the next one is fixed overhead expenditure variance. This one is just talking about how much do we budget to expend in fixed overhead and how much do we actually expended in fixed overhead. If we budgeted to expend 1 million naira as our fixed overhead. At the end of the day, what do we now eventually expended? We expended 1.2 million naira or 1.3 million naira. So the difference between 1.1 million and 1.3 million naira that we actually expended is what the fixed overhead expenditure variance. I hope I get what I'm saying now. So the addition of the fixed overhead expenditure variance and the fixed overhead volume variance is what we call the fixed overhead cost variance. Don't forget, addition of the material cost variance, the labor cost variance, the variable overhead cost variance, the fixed overhead cost variance is what will give us the total cost variance. I hope you understand that now. Now let us now look at the other side or flip side of this variance, which brought about the differences between what? Budgeted profit and actual profit. That is the sales variance. In the exam, examiner can now come from the angle of what? Of you computing what? The sales variance. Let us quickly look at what do we mean by sales variance. Sales variance are those variances that are due to what we envisage to. I guess what I'm saying. That's more of what they mean by what? By sales variance. Now, in this instance, now, if I'm looking for the sales variance, there are two things that can actually lead to the variances in sales. Now, the first one is what is the price of we are selling or the volume of sales we are making. Let's start with the price. The price simply means sales price simply means if the price we envisage to sell the product, if it's different from the price we actually sold, that means that you're having a price variance, and that's a price variance. Please note it. It's a price variance is what is the variance between price we went to sell and the price we actually sold. If I want to sell for 10 naira and I now sold for 13 naira, what's the difference? 3 naira variance now? Is it not? That means that variance is what calls sales price variance. Hope you understand what I'm saying. Now, the next variance we have is what? Is sales volume variance. The sales volume variance is the variance that is due to the what? To the difference between the volume of productions. I hope you get what I'm saying. It means that if the volume of products that we're looking at selling is different from the volume of product we are looking at, we are actually sold, that means that it can affect the total sales, which that variance is what we call the sales volume variance. Don't forget, the addition of the sales price variance and the sales volume variance is what gives you what? The sales variance. While the addition of the sales variance and the cost variance is what gives you the profit variance. Now, in the exam, examiner can now ask you to go ahead and compute all these variances. That examiner can ask you. And how do you go about computing all these variances? That means that you must first equip yourself with the formula of computing these variances. Please don't get me wrong. It's not compulsory that you know formula. Even if you don't know the formula or you know what you are computing, nobody's going to penalize you. I get it. But for you to fast track or to be able to get this computation easily, that's why they always They always devise a formula to use in the computations of these variances. So in a nutshell, compute these variances. What are the formula that we can use in the computation of these variances? Let us now look at this, please. Look at this. And now highlighted those formulae here. Now it depends on the one you are taught in class, the way you are briefed in class about the way to compute these variances. But I put it in a very simple way to compute. So let us look at some of the formulae and how to quickly code those formula in the exam. You can see I abbreviated the formulae so that you what you know if I even use a format for getting those variances. Now look at it. Number one is material price material price variance. Now, when we say material price variance, what do we mean? We are looking at the variances in what in price. You need to spot that variance that we are computing. If they say material usage variance, we are computing usage. If you say material price variance, we are computing price of the material. And that's one. Two, I want you to quickly understand this, that in the course of computations of all these variances, it's likelihood that they will be expressing the information in two different things. That is material and the product. Don't forget that materials is different from products. Let me give an instance. Materials is flowers. Why product is bread? If they say materials, please note that we are talking about what they use in producing the product. Product is different from materials because that is what normally confuse students in the exam. Because they normally confuse product with what? With material. Let me know whether we are following, please. Let me understand. Let me see whether I'm on the same page with us. Are you getting me? Are we following, please? Oh, Olalu say, okay, Tony, thank you so much for following. Okay, that's cool. Yeah. That's cool. Thank you. Now we are actually looking at these variances now. The first one is material price variance. Now, when we say material price variance, we need to spot what is that variance that we're looking at. We are looking at the variance in what? In material, in price of material. That means that variance will be what you'll be picking. It's now the price variance now. That's different between the standard price and the what? And the actual price. That's what you are looking at now. The difference between the standard price and the actual price. Can you now see? If I'm looking for material price variance, what's the difference between the price, standard price is SP, and actual price? Let me give an instance. If you want to get the standard material price variance, we're looking at if you are producing product with flour, what is the price of buying 1 kg of flour? Are you getting me? We want to buy it maybe for 2 naira. That's the standard price of that material per kg. And we now bought it for 3 naira. That's 3 naira per kg. That simply means that what? That's different between the standard price and what? An actual price. Then that difference is 2 minus 3, which is 1 times the actual quantity of the material they purchased. If I venture they purchase 1,000 of that material, that means that it will be 1,000 actual quantity times the 1 naira difference in the prices. So that simply means that if I'm computing material price variance, what I'm looking at is I'm looking at the variances between what? Between the price I envisage to sell to buy and the price I actually bought. Then I will now value it and multiply it by the actual quantity of the material I purchased. That is 1. 2, material usage variance. Under the material usage variance, I'm actually looking at the variance between what? The standard quantity of the material and the actual quantity of material I used. I get it. It means that how many kg of material did I envisage to use for what I actually produced? And what is now the actual quantity of the material I used? I hope I get what I'm saying. I'm looking at the difference between standard quantity of material and actual quantity of the material used. Now, if you're looking at that difference between the standard quantity and actual quantity, we have what? We have a material usage variance. Don't forget, this standard quantity examiner will not give you in how many quantity have you set to produce one product. It means that how many flour have you set to produce, how many kg of flour do you set to produce one bread? Then if you know that kg, assuming the kg is 2 kg, you are set at the beginning. Then when you now produce the bread eventually, assuming you produce 1,000 bread eventually, which is actual production, then you multiply the 1,000 actual production of bread and the 2 kg of flour that you set to use for one. Then that's 2 times 1,000, that's 2,000 kg. That 2,000 kg is what we call the standard quantity. Can you understand that now? That standard quantity is what is determined by referencing it to what? To actual productions. I guess that's why in the exam, if you are finding your standard quantity, it will be what you set to use to per one. Standard quantity per one of that bread. That's the flour I want to use per 1 unit of the bread. That is how many bread I produce, actual production. So in this instance, standard quantity comprises of two things. You are multiplying two things. You are multiplying flour and bread. What is the flour you set to use to produce one bread? And how many bread do you actually produce? That will give you the standard quantity of the material or flour to use to produce one, all the bread you produced. You compare that standard quantity with the actual quantity of the what? Of the materials of the flour. So if you compare the two, that two will now give you the variance in the what? In the quantity or usage. Then you multiply it by standard price. So it means that you need to multiply it by base price, which is the standard price. That gives you the variance. The next one is labor efficiency, not labor usage. You can even call it labor rate variance, not usage, not U. It should be R. LUR rate variance. Come rate variance. We are looking at what rate of payment. It means that if I want to pay that what at 6 naira per hour, which is the actual, that means that the variances in my rate of payment now is what is the 4. We now multiply by actual hour. I guess the data that is used for the now. Thank you. That's labor rate variance. Sorry, the network is actually not friendly, but we just work with what we have. Now, let us now continue. The next one is now what? Labor efficiency. Variance. Now, you can what? You can also quickly get your variances out. Because if you just say what is common to each all the standard fixed overhead aversion of it, they now see the volume, efficiency, and capacity, and now start it in. So that is that fixed overhead expenditure. That one is straightforward, please. I think we're having a stable network now. I'm sorry. So that one is now for the fixed overhead expenditure variance. What we're actually looking at is just the difference between budgeted fixed overhead cost and actual fixed overhead cost. So what's just looking at here is just what do we want to spend and what do we actually spend. That's just the fixed overhead expenditure variance. So this acronym fixed overhead expenditure variance is budgeted fixed overhead cost and actual fixed overhead cost. I hope you understand that now. That is that. Now number 11 now, that's sales now. We're now in sales now. Sales price variance, what are you looking for? The difference in price, right? That means standard selling price, that's what you want to sell it, and actual selling price, what you actually sold it. So standard selling price is standard selling price. We're looking at the difference between the standard selling price and what the actual selling price. I hope you are getting me now. Now the standard selling price and actual selling price. So that's the difference between the two. We now multiply by what? Actual quantity sold. I hope you're getting what I'm saying now. So the difference between standard selling price and actual selling, if you want to sell for 2 naira or now sold for 3 naira, that difference now, you now multiply by actual quantity they sold. That's AQS. Now, why the sales volume variance is now talking about variance in the volume of sales. I want to sell budgeted quantity, what I'm looking at selling, and actual quantity sold, what I actually sold. That difference now is what we mean by the word volume difference. That's volume variance. You multiply it by what? Standard profit. I hope you get what I'm saying now. Sales volume variance is talking about the difference in the volumes of sales. How much do you want to sell and how much you actually sold times the standard profit. I hope you understand. You don't use standard price, you use standard profit because profit is what you use to value the volume. I hope you are getting it. That's and all my acronyms in the exam, please tell them the meaning of the acronym. The MPV happens to be material price variance, MUV efficiency variance, IVID variance, and so on. Please note it. Let's now look at the questions. Now, assuming the exam, examiner now gives you a question under variance analysis, and they ask you to compute the variances. What will you do? Now, at this level, what you should look for in the exam, because it's possible they bring it in that they add at least a new syllabus, is a new topic to your syllabus. I mean, it's actually a major topic in the skill level, but they added it to your syllabus, hopefully, so that they can integrate it into knowing what exactly we're looking at when we say variance. Now, in this analysis now, if you are asked to be given a question on variance now, the examiner will give you the standard information as well as giving the actual information. Standard information is what is set to incur or what is set to sell of the product, while the actual information is what they actually incurred or sold in the period. So that standard and actual is what you now need to start relating or comparing for decision making purpose. Now let's start here. Now see. Sleepwell PLC is a manufacturer of beds. It uses a standard absorption costing system. Now, it says Sleepwell PLC, that's the company, name of the company, is a manufacturer of beds. It manufactures beds, sleeping bed. It uses a standard absorption costing system to monitor performance of managers and departments. To monitor performance of managers and what? And departments. Now, a standard They are now given what information about the what about one of their products. A standard absorption cost card for one of his product, the dreamer, is given below. Look at it. Selling price. How much are they selling the product? They want to sell it for what? 2.50 naira per unit. That's the selling price, standard selling price. Now, how much the production cost now? The cost they incur, the envisage, all these are standard information. I hope you know per unit, per one of that product. Now, they want to sell it for 250 naira. But when they are producing that product, the material they use in producing it is measured in meter. They want to use 12 meters to produce one of the products. I guess it. That's standard material. And for each of the meter, it is what 1 naira 50 kobo. What do you do? Now the 1 naira 50 kobo per meter times how many meter to produce 12 meters? That'll give you 18 naira. Now the direct labor cost is 4 hours. They say that they will use 4 hours to produce one of the products. And how much is the rate of hour? They pay 6 naira per hour. That's how much 24 naira. Now the variable overhead variance is what? 4 hours also at 15 naira per hour. It means that the rate of variable overhead is also 15 naira per heavy hour, which is how much 60 naira. That's 15 times what times 4, 60 naira. Why the fixed overhead is also what? 10 naira per hour. That's the rate times 4 hours. That's 40 naira. That's the cost of what fixed overhead per unit. You can now understand with me. Look at what we understand with me. You quickly understand with me that even the hours they give for what to labor, to variable overhead, and to fixed overhead are similar. It's not a coincidence. It's because mostly that fixed overhead is absorbed using that hours, and labor is also absorbed using the labor hours. I mean, the variable overhead is absorbed using the labor hours. That's why you see 4, 4, 4. But the rate of what of the rate of each of these items, that labor is 6 naira per hour. 15 is, I mean, the variable overhead is 15 naira per hour, while the fixed overhead is 10 naira per hour. When they added all these costs together, that's 18, 24, 60, and 40. They got cost of sales of what? 142. That's what they deducted from the standard selling price and get the gross profit of what? 108. So they are expecting to make it 108 naira on each of the products. That's what their budget is. Now, apart from that, now, they now said the budgeted production and sales are 1,000 dreamers per month. That's what they are budgeting to produce and sell, which is 1,000 dreamers per month. That's the envisage that what their production will be is 1,000 dreamers per month. Now look at it. They now give it to us as okay, the actual information now. They now say the actual result for the manufacturer and sales of dreamers for the most recent month was as follows. What's now the actual result now? Was as follows. What now actually happened? How much they actually incur? I get what I'm saying. How much they actually incurred? I'm sorry, is what is now. Look at this. Sales, they actually sold 1,200 beds at how much? 240 naira each. It means that what they now eventually sold is actually 1,200 beds at 240 naira for each of them. But they produced 1,300 beds. So when someone produced 1,300 and sold 1,200, then it didn't sell everything now. It's mainly a closing stock of 100. So please note it. Why the material they purchased and used, the one they purchased and used is what 16,000 meters at 1 naira per 140 kobo per meter. That's material purchase and use. Why the direct labor work and paid, not pay at place, work and paid. They work and paid for 5,000 hours, and the rate of what of payment is 6 naira per every hour. Hope I get what I'm saying now. So that's that. So they now said, okay, fixed overhead, variable overhead rate, overhead, total. They gave us total, they didn't give us the rate there. 75,500. Why the fixed overhead is what? 54,600. These are the actual costs they incurred during the period. And there were no opening stock or finished stock. They now ask us, compute the following, calculate the following variances for the most recent month: direct material price, direct material usage, labor rate, labor efficiency, we provide expenditure, we provide efficiency, we provide expenditure, fixed overhead expenditure, fixed overhead capacity, fixed overhead efficiency, sales volume in terms of profit, sales price. These are the variances. And I ask you, prepare a statement to reconcile the budgeted profit, which was with actual profit. That means that the reason why the profits they projected to make is different from the profit they actually make. It's because of all these variances now. So that's why we need to look at it deeply. Let's look at it now. Let us now look at this, the questions. We'll now use the formulae to pick those answer out. Let's start with the word material price variance. You will see the way I will be picking it now. If I want to pick the standard information, I will go to the standard cost at above. If I want to pick the actual, I will go to the actual information. And that's how to do the variance. Let's start with the material price variance. Material price variance was difference between standard price and actual price at actual quantity of material. Now, what's standard price of material? Let's go and check it. What's our standard price of material? Our standard price of material is this. Look at it. Look at the material. This is standard information. And the material price happens to be 1 naira 50 kobo per meter. It is not 18 naira. 18 naira is just the cost of the material per 1 unit, but not the material per kg or per meter. So the per meter of the material per 1 meter is 1 naira 50 kobo, which is standard price of material. So you now go to the actual information. You now go and pick what's the actual cost of actual price of the material. That's 1 naira 40 kobo. So that's why if you see in their solutions, you now see 1 naira 50 kobo minus 1 naira 40 kobo times the actual quantity of the material purchased. What's the actual quantity of the material purchased? That's the AQ. Actual quantity of the material purchased. This is actual now. You now go to the material. How many they actually purchased? Purchased and used was 16,000 meters. So that's why you now see you have 16,000 meters. 16,000 into 1 naira 50 kobo minus what? 1 naira 40 kobo. That's 0.1 times 16,000, which is 600 was favorable. Now that's 1. 2, B is material usage was variance. The material usage variance is divided is what is based on what? You see, can you see this one is favorable now, right? The material usage variance is talking about the difference in the usage of material. That's standard quantity of the material they want to use to produce what they actually produced. That's standard quantity they set and the actual quantity they used. That's standard quantity minus actual quantity. Then you value it with what? With standard price. Now, I told you they will not give you the standard quantity directly. You need to find it by saying standard quantity per unit times actual unit produced. Let us go and check standard quantity. You see the way they get standard quantity now. You get it under the standard information. The standard quantity per unit of the material is 12 meters. So it means I will set that the meter of material we're going to use is what is actually 12 meters. Sorry, please. Turn the light. Okay. Now, so hope you can see me. As I was saying, that is the material usage now. Standard quantity minus actual quantity of material. Let's look at standard quantity of material. You now come to this material under the standard. What's the quantity of material? 12 meters. 12 meters is what they say to use to produce one of the products. Then how many of the material did they actually produce? They actually produce what? How many of the products they produce? They produce 1,300. That means that standard quantity will be 12 meters times 1,300. So check the way they put it there. The standard quantity is 12 meters times 1,300. That means that we wanted to use 12 meters to produce one, and what we produce 12 meters of flour times 1,300 units of product or bread. That will give you the total that quantity they use to produce the 1,300. Now, what about the actual quantity now? The actual quantity of the material now, you go to the so under the actual, they will tell you what the actual quantity they use. Can you see this is material now? The actual quantity of material is 16,000 meters. Because it's actual. So it's not in for now. I don't know what happened. There should be network from my side too. So let us now look at it. So material usage variance now